So when you see people that are hinting to you, let's make some quick money, let's do something that's going to net profit in the next year or two, you should really run from them. And it's almost always a signal of, just unreliability, some diciness, some strangeness that's actually happening. And that's a strong signal that A, either that person doesn't know what they're talking about, or B, that they're trying to con you in terms of doing something that taking money from you, basically. And I think my gut feel whenever you see anything like that is to kind of bristle and be like, I don't know about that. And the reason is that there's a simple sort of artifact that you should look at and readjust your expectations based on, right? And that simple artifact is the best companies in the world on average, based on index funds, make on anywhere between 8 and 12% every single year, right? On average, that's like over many, many years, right? So that's like 30, 40 years, 50 years on the stock market. And that gives you a sense of, okay, so these are the best companies, right? To get into stock markets, there's thresholds to be made. It's, publicly available. It's pretty hard to get onto these exchanges. Now, there's probably better private run companies, absolutely, but there's also worse ones as well, right? And we have to sort of think about that. Like, how do we adjust what we're thinking about, given that the best companies in the world make 10% per year? So what does that mean, right? So that means a realistic expectation for next year for you is to assume any project is going to make, so if you put in $1, a realistic expectation should be that you're going to get $1.10 back, right? Like that seems, so if you're putting in $10,000, you should get $11,000 back. Now, that is based on the best companies out there. So your expectation generally on something that's not proven, or, maybe if it's like a Subway or something like that, that that is very well proven and the sort of everything is understood, then that's probably your expectation is going to be somewhere around there. Now, if it's completely new, you've never heard of this thing, it seems like some money-making scheme, you would probably expect to make less than that, right? Like probably you're going to make, probably 60 cents for every dollar that you invest. So you put in $1, you're going to get 60 cents back, and that's it. And it kind of gives you a realistic expectation for the future if you start thinking about that. So in 2 years, right, if you put in $10,000, you should expect $12,000. That's what you like. So you put in 10,000, you get 12. Not 12 as in like profit, but 12, that's $10,000 plus an extra $2,000 back. Right? And that is pretty reasonable expectations of where you should sort of see things going. And if anybody says it differently, right? Like if you invest in these houses over the next 5 years, you're going to make, $100,000. You put in $10,000, you make $100,000. That is dicey. That makes me nervous. I'm always like, really? Is it? And generally it's not, right? And if you do, right, if that does happen, you're exceptionally lucky for that to happen. On average, you should be thinking about on average, right? Like, what does it mean on average? What's going to happen? And that's why I almost default always to index funds and mutual funds all the time. Because we're thinking about on average, what is it that the best managers in the world and the best managed companies in the world, what are they expecting? And they're expecting basically that, to grow by 10% per year. Now, that doesn't seem like a lot, right? 10% per year seems like, but I want you to look that up. If you look at compound interest calculators, it's really easy to do. The mathematics behind it is actually quite simple. but it requires a little bit of understanding. That amounts to a great deal of money over 20, 30 years, and a great deal of growth that is quite spectacular, that you should sort of expect, right? Is going to be spectacular over 20, 30 years of making that investment. Now, if you were to say, I'm going to buy a house, and the expectation is it's going to be quite spectacular over 20, 30 years, I'd be much more likely to believe that. However, I'd also sort of look at the long run averages of houses, which is generally a lot less than that, a little above sort of inflation rates, but that might depend on your area and all that kind of stuff. But generally, it's not going to be spectacular, right? And it's more of like a piggy bank that sort of matches inflation. And that's what I want you to sort of think about. How can I recalibrate how I'm thinking for the long run, so I'm not doing anything that's like dicey and scammy and, just things that are too good to be true. And they almost always are, right? If you see something that's like, wow, this Bitcoin was the latest thing in the last little bit. AI is probably going to go through that, where people are like, oh my God, invest in AI companies, we're going to make a bunch of money. Generally, that's not going to happen, right? Like, there are going to be lucky situations where you're going to make exceptional amounts of money. But they're lucky. They're just plain luck, right? There are people that are going to benefit, but they're lucky. There's that there is some skill to picking that luck. But let me tell you, it is very hard to be skilled to understand what is going to be the next big thing. And I would never do it myself. The only reason I'm doing this whole reciprocity project is I know that I want to help out people. I know that I have some understanding of how things actually work that I would like to share. And I know the other thing is I look at the growth of the internet. It's been occurring for a long time. It's actually quite spectacular how much the internet is growing and what I expect it to grow. And that's long run average. I started eventually thinking about this. It's like, why am I not investing in this in terms of my own personal effort? So the thing is I'm not expecting it to make a whole great deal of money in the short term anyways, right? And it's not been that way, right? My expectation initially was like, that might be the way. But man, I'm proven again that these law of the long run averages, it comes back and bites you, right? It's always that case. So I want you to think about these long run averages are really, really important. So right now, this whole reciprocity project is not necessarily that big of a deal, but it's growing and it's becoming a bigger thing. And I want you to sort of think about that as well, right? Like, doing something over a long time, what does that mean? What do these long run averages actually mean? What does that look like? There's a lot to sort of say about that. There's lots to think about with that, and you have to default to, okay, my expectation for next year, I've invested $1,000. I'm going to expect to make above that $1,000. I'm going to expect to make $100, and that is pretty reasonable. Above that $1,000 to expect that. Now, with something that's unproven, right? And most things are unproven. Like, that would be if you're investing in Subway or you're investing in Walmart, for example. I'd probably expect that. But, if you're investing in something unproven that hasn't been around, somebody's making crap up, like all of that, you're lucky to get your money back, right? Or a fraction of what you've actually invested in. So you're lucky to so you put in $1,000 and you only get $250 back. And that would probably be a pretty reasonable expectation. And so you have to look at, okay, I've invested that much money. How do I reconcile that? And that's where you have to think about, hey, this is maybe just charity work. This is something I believe in, lots of those different things. I'm going to be a sucker here. I realize that, but I know that this is important. All right, take care and have a wonderful day. Bye.